Hi, everyone. Thank you for joining us today. We've got an excellent panel discussing uh, what's inside an EB-5 deal and how projects are structured, vetted, and sold. We'd like to go through some of the elements and talking points when it comes to structuring a project and everything that goes into the selection process for projects as well. We do have a great panel today. We've got Andrew Wall and Trevor Anderson joining us. And let's get right into it with some introductions. Andrew, would you like to kick off with your introduction, please?
Yeah, thanks, Christian. So Andrew Wall, been doing EB-5 for about 13 years. Now a licensed registered agent with under Dalmore Group, focused on assisting the investors in selecting their project and understanding the offering so that there's no surprises in the future.
Trevor?
Yeah, thank you, Christian. My name is Trevor Anderson. I'm the director of EB-5 for HomeFed Corporation. So we are a real estate development company, wholly owned by the publicly traded Jefferies Financial Group. We specialize in very large real estate development projects around the United States. And we've been active in the EB-5 market now for about 10 years, helping fundraise some of our various developments.
Great. And then, as I mentioned, I'm Christian Triantafilus. I'm an immigration attorney. I've been working on EB-5 matters since 2011. I work with EB-5 investors from all around the world. I also work with regional centers and EB-5 projects throughout the United States on their EB-5 raised fund matters. I'm the managing partner of the business immigration practice at Jackson Walker. We're a full service law firm located in Texas, and I'm out of our Houston office. So again, thank you both of you for joining me as we go through some of these important discussion points. Especially at this time of the EB-5 uh, industry, everything that goes on in the EB-5 climate, we know we always have deadlines approaching, changes afoot. But for the next year or so, we're going to have a lot of certainty that we know EB-5 investors can take advantage of as we approach September 30th of 2026, which we know is protected by law in terms of being able to invest at the $800,000 level and under the current EB-5 regulations and requirements. So project selection is a very key aspect of all of this, of course, both from an immigration perspective and an investment perspective. As an immigration attorney, when I work with EB-5 investors, my focus is on making sure that the project they select will facilitate their EB-5 immigration process. I want to make sure that my clients can get a green card out of the project that they're investing in. But there's more to it, especially when I have these conversations with clients and they start to ask, how's the deal structured? Why was this project selected? Is there anyone out there that can help me look at this from a financial and due diligence perspective beyond the immigration requirements? And I think that's where the two of you also come in as the other pieces to the puzzle when it comes to working with EB-5 investors going through the immigration process. All right, so we've picked out a few topics. It's quite a big overall discussion that we could have, but we've picked out a few topics that we think are some of the top issues when it comes to project selection, both from an investment and immigration perspective. So let's start with the cap table. What financing, what funding goes into an EB-5 project, and what are the two of you considering and evaluating when putting together that cap stack or helping a client choose a project based off that kind of table? Are you looking at what kind of equity goes into it? What valuations have been worked into their models? Tell us a little bit about that. Trevor, as you all do quite a bit of EB-5 funding and rounds of projects, tell us about your methodology when it comes to that.
Yeah, so within the EB-5 space, you're going to see a variety of different capital stacks and financing structures. But in all cases, we want to see the developer putting in a substantial portion of equity. We want to know that the developer believes in the project and they're putting, their money where their mouth is. We want to see the developer highly invested. Typically, there will be some bank debt, and there's nothing wrong with that per se. But in a best case scenario, we like projects that don't have bank debt. We want the EB-5 investors to be in the first position, right? We only are going to invest in projects that we believe are safe and that are going to be successful. But the only true way to protect the investor's interest is to make sure that they're in that first position. Because sometimes things happen. We can't control the market. We can't control the outcome of the project. But making sure that the investor is in a first position and well protected by significant developer equity is the single best way to protect the investor's interest in a project. So it's certainly not always possible to find that. You're going to typically find bank debt in projects, but as long as the equity is sufficient from the developer, and the investors have adequate security, we can find structures that we're comfortable with and that we feel good about.
Yeah, Trevor, you kind of beat me to the punch there. Not everybody, not all developers, there aren't enough slots with you alone for investors to be able to get into a deal that is in senior position, for example. So yes, that's a very advantageous position to be in. And if you have that ability to do that, it's understandable why you're setting it up for success in that way. So Andrew, as someone who works with investors, looks at projects, I'm sure you see all kinds. What kind of equity are you expecting to see, or your clients expecting to see? How dependent can a project be on EB-5 financing? Tell us a little bit about that selection process, especially when you see deals like, the home feds deals in the market.
Yeah, I mean, we'd love to see like 10 to 20% skin in the game equity from the developers. And then when you're saying in a first position, sometimes these deals are collateralized with an alternative collateral piece. But when you're in a first position, whether it's the asset that you're investing in or the alternative asset that you have a first position on, you like for that asset to have value, right? And when you go into a deal and whether or not the developer has a significant amount of equity, if it's a deal that is very niche market and there is no one else that could come in behind that individual developer and redevelop that deal and take it on, where is the value really in the first position? The EB-5 investors are not developers. They're part of a fund and they intend to invest with the primary focus of getting their capital back. They don't want to take this over and there's not additional upside. So while you have a first position, I want that first position to be in an asset that has value. Those assets have value from whether we're seeing a lot of mountain towns where there's a finite amount of space. So they're never going to be enough land value by mountain towns or by water or something where there's a finite amount of space where it creates a high barrier to entry. We have worked with Trevor's deal before, and part of their barrier to entry is there's not much more land to build in San Diego, and there is a barrier to entry for the permitting and zoning process. And those are protections for the investors that get into a first position on a piece of property like that. We love seeing that because it protects downside risk. We're not looking for upside, right? We want what you want, Christian. We want the conditional green card and permanent residency eventually, and a return of capital. Like that's our protection. So downside risk protection is our focus.
So it sounds like you're looking into projects that have some kind of high value aspect to it, if I'm putting it in a maybe
Yep.
simpler terms. Not necessarily something unique about the project, but something that you can identify as high value and will protect it when markets get a little bit more difficult, and kind of emphasizes the equity that's also been put into the project as well. Is that a fair statement?
Yeah, and we want to know that this project would have taken off without EB-5. If it was stagnant for the past 4 years or 3 years or whatnot, and there was always contemplations or negotiations with banks and trying to find the right interest rate, is this project only penciling financially because EB-5 is available, or would this have taken off anyways? I know there's a lot of developers out there that have had multiple deals going on in the same area, and that shows value in that area. that it was working prior to the rise in the set aside category for EB-5. So I think that's important to me as well.
Great point there. We've definitely seen a shift in focus on the types or locations of projects since the EB-5 Reform and Integrity Act, and that emphasis on rural deals, for example. And it's been interesting to see how certain developers have started to pinpoint what constitutes a valuable rural deal, not one that just is moving forward to make sure they're completing the immigration requirements, but to the points that you're saying are protecting the investment. So that kind of moves us into the discussion on the use of the EB-5 capital. The deal's been identified. What are you, and I'm going to start off with you, Andrew. What are you looking for when it comes to how your clients' funds are going to be used on the project? You mentioned it already, but I'd like you to touch on it again. Kind of where are they in the construction phase? What do they need to commence development? Those types of issues.
Well, we like to check boxes similar to what a bank would be doing, right? Banks do not want to take on risk. They're here to just keep their capital at play and earn a minute amount of interest on that capital with essentially no risk. So if we could be in a project that is already taken off, that has all their permitting and zoning set up, and in the ideal scenario, that project has been funded already to an extent where bridge financing is in place and the EB-5 investors are coming in and replacing bridge financing. And I think that helps us out in multiple stages. It helps us out in reducing the risk from the financial aspect of any construction risk early on. It helps us out where job creation is going on. We see and we can visualize what's been happening. We know individuals have been getting paid, that there's no liens on the property. You have all your individual employees. Obviously, in the current immigration environment, a lot of the manual labor jobs may have been coming from individuals or corporations that had people who were on visas that they overstayed,
Yeah.
whatever it could be. So I think that's a factor that we take into account. If things are already ongoing, that's a huge checkbox for us, and we don't have to worry about getting deep into the zoning and permitting of that specific asset.
Yeah, I agree. That's a common remark that I make, especially from just primarily on a job creation standpoint. I want to make sure that, my clients are not investing in something that just becomes a hole in the ground. We need to see expenditures and job creation. With that being said, Trevor, when you're going forward with your projects and phases of different projects, when does your group become comfortable with deploying capital? Opening up a new raise, filing a new project. Tell us about that in terms of how you like to use EB-5, the actual EB-5 investment.
Yeah, it's a great question. I mean, for HomeFed projects specifically, we're using a bridge financing model, meaning that HomeFed is funding these projects. We're constructing these projects, ahead of EB-5. There's no dependence on EB-5, and so literally the EB-5 investor is coming in after jobs have been created, in some cases after the project's operational, after there's already been sales revenues. And so we're really, really trying our hardest to mitigate risk to the EB-5 investor. They don't have to worry about job creation. There's very little concern over financial feasibility because we're already proving it. We're already putting our own money out there. And this is obviously an idealistic scenario that you're not going to typically find in the market.
Mhm.
But if you can, it's a great option. If you can mitigate those risks and just take them off the table, hey, why not? But of course, there's good projects that don't do the bridge financing or they haven't necessarily created all the jobs, but they're in process. You can see that is in front of them, that it's imminent, that we're not going to be waiting 1 or 2 years for construction to start. These are simple things that we can try to avoid to make sure that we're satisfying the immigration requirements, namely the job creation, and that we're going to get our investment back, by investing in a project that is going to be successful. And again, looking at the investor's track record is a big part of that as well, and understanding what they have already done and understanding what they're capable of. But again, that bridge financing model is a great option if you can find it. And if construction's already started, that's the ideal timing.
Yeah, with this floating around the sustainment period, Christian, I think the deployment of capital is a really big issue potentially. I'd love to see the capital deployed because it's necessary, right?
Right.
But not necessarily just because. So there are kind of protections within certain firms. Well, there'll be like a drawdown request for a specific portion of the deal that's getting constructed to whatever contractor it is that's needing it, which is a huge deal for me. And I think Trevor's deal today, we obviously get a lot of focus on rural deals. And that's a huge focus and demand for the investors. But if you go into a deal that has high employment, you want to understand that there's an institutional team behind it that has
Mhm.
prior successes that they can finance this thing whether or not EB-5 comes in. So if there's a hiccup in whatever market it is that's coming out, whether it's the Chinese market and managing funds outside of the country, whether it's source of funds in Vietnam, whether it's a sale of assets in a certain country where there's volatility with the government, you want to be able to be secure that regardless of any of these external factors, the development will move forward. So I think it's important to have like a strong team and base behind that.
Yeah, I do always say that, EB-5 is one of the most predictable ways to immigrate so long as you have an experienced team within EB-5. And that may be
Yeah.
stating the obvious, but there are lots of real estate developers out there. There are lots of broker dealers out there, lots of immigration attorneys out there, but it is a very niche market. And, not, and beyond that, to have that experience among those three different groups is very important for that success. But you mentioned something that I want to maybe touch on a little bit further. You started talking about the deployment of capital. And I think across deals, sometimes you see different triggers for different amounts of the EB-5 capital being deployed from the new commercial enterprise to the project. We see sometimes funds being deployed on an investor by investor basis as investors come in and file. Or perhaps you see the funds being deployed in larger chunks or on certain dates or other triggers being implemented into the offering documents and loan agreements. Is there something that you're looking for, Andrew, when it comes to that deployment? I mean, you mentioned the importance of getting that sustainment period going. Tell us a little bit more about some of your analysis when it comes to that.
Yeah, so I think a lot of our decisions become a focus to where we've been a historian in EB-5, right? And we've seen situations where prior documents didn't contemplate the concept. And this is maybe almost 10 years ago now, but didn't contemplate the concept of redeployment. So you got batched in with the individual next to you where he had to meet his immigration requirement, but he may have been from China with a longer or retrogression than you would be from a Latin country. So you kind of got boxed in. Ideally, I would like to be in a project where when my money is deployed and my funds can make it back to me based on my own personal process. So ideally, you're batching it and groups of people that are like-minded, or you actually have the exit based on your own personal immigration process. I think that's a huge deal for me. I don't want to be dependent on someone else. I already have 100 variables coming at risk, and this is one I'd like to alleviate.
Yeah, I'm in agreement on that. Although, I do know that projects like oftentimes to call loan proceeds, for example, in batches, in tranches. You
Yep.
know, Trevor, is that something that you prefer to see as well, so you can spend larger amounts of money at the same time, or are you deploying funding on an investor by investor basis?
Yeah, it's a great question. Yeah, you got to look at the loan structure and understand, is there a single loan start for all the investors, or does your investment period only begin when they're released from escrow? And if so, when are your funds going to be released from escrow? Is it
Yeah.
going to be in the next 3 months, 6 months? Is it going to be a year from now? So obviously we like to have, some sense of our investment and how long it's going to be invested for. And so we like to see that funds are being released consistently, as the developer is able to utilize that funding. We don't want to see funds sit in escrow for an extended period of time, which ultimately just lengthens the investment to the investor's detriment, right? They're not benefiting from that money sitting in escrow. So we like to see funds, ready to be released from escrow and to be used in the project. Um, you know, Again, we want to be as efficient as possible, while also, being safe. We don't want to be reckless. We don't want to give the developer money if they don't have a use for it. We got to make sure
Right.
that the money's being spent appropriately, that it's spent towards job creation and towards advancing the project. But I definitely want to see funding released from escrow, on a quick schedule. I don't want to see delays necessarily.
I think we also don't want to be too efficient. If
Sure.
you become too efficient and that developer can repay you or it exercises repayment before even the minimum defined sustainment period today, 2 years,
Right.
then what happens, right? Then
Yeah.
all this research you did for project one as a group, we have to go do research for project two, just to meet your immigration requirements. So I think there's two ends, um, a dual-edged sword there.
Yeah, for sure. And I mean, you'd like to believe that those timelines are clearly spelled out in the business plan. The loan will describe whether there are prepayment options or not. And those are the types of things that, investors can, ask directly to you, Trevor, as you raise capital. And Andrew, those are the types of things I'm sure you get into discussions with your investors as they look into what's the use and timing on repayment of my capital, which leads me to ask, what type of repayment or exit strategy, I should say, are you hearing that investors are preferring? Because you do have to juggle, the too soon versus too long issue that you brought up. So, each deal has its own exit strategy described, but are you starting to see a certain average amount of time become industry standard, Andrew?
In you're referencing kind of the terms of the offerings.
Yeah, like in terms of how long you are seeing the NCE and the JCE going to be sustaining that investment between one another. How long is that loan or
Yeah,
equity investment between the two entities kind of going to be out there before the investors would get their funds back if all goes well with the project?
I think 3 to 6 years is really the average we've seen out there. And
Yeah.
I think that's a viable average. And there's like again, a historian aspect to it. The concept of the sustainment period and undefined term today made it also unclear to the developers on what that term should be. So they created flexibility to protect those investors. And we appreciate that flexibility. But there also needs to be an understanding to the investors that there is clarity on those options for extension. So when I talk to an investor, if it is a 3+3 1 year options for extension, generally, and it's not always the case, but generally I say prepare for the worst, right? Prepare for to be in this project for 6 years. And it doesn't always mean it's a bad thing. We still have undefined terminology of sustainment period. So it could be a great thing, right?
Yeah.
Ideally, you don't want to get repaid and have to take on an additional risk somewhere else. So if you could be in the same structure for an extended period, at least you're comfortable with the initial investment that you made.
Understood. Trevor, how does a project, and I'm not specifically asking, on yours, I don't want to, that's not what I'm trying to do, but how does a project generally pay back a loan or preferred equity, for example, to the NCE?
Yeah, so in most cases, you have one of two options. We either have a sale event or we have a refinance. But in either option, I mean, one's not necessarily better than the other. Depending on what it is that you're investing into. Sales can be a benefit because you may be selling, components of the project. You may be selling over a period of time, and so you're not reliant on one very large transaction to make the project successful, right? If you're selling a single, hotel, for example, that's one sales transaction. It's one refinance. So you're dependent on that one transaction going through on time at the right price and being successful. Whereas if maybe you're selling, condos or houses, you may be recognizing, sales over a period of 2 or 3 years. And so it allows for some flexibility in the repayment and the timing. It kind of hedges your bets, right? Maybe 2026 is a bad year and we're not selling or we're not refinancing, but maybe 2025 and 2027 are good. And so if we can spread the risk, if we can mitigate, the downside, I find that to be helpful. But in either scenario, both can be very valid and successful options for for repaying the EB-5 loan.
And I figure that, Trevor, this is kind of back to you, but I figure that the extensions give additional protections to the investors because you're really a team with a
Yeah.
developer, right? And you don't want to put the development under the fire to sell or refinance by a certain date because of what you said. There's variables in the future that we don't know what the market's going to be, and we can gauge to an extent, but we don't know. So having flexibility allows you to find kind of what I think would be the best partner to exit the deal.
Yeah. No, absolutely. Yeah, we don't want to force the borrower, force the developer to sell at a discount. That they may not even produce the funds needed to repay the loan entirely. But if we can give them an extra year on the loan, and that
Mhm.
allows them to come up with the cash needed, then that's great. Everyone wins.
And do you all see changes in interest rates occur when extensions happen, whether it be lender or borrower side?
Yeah, typically we see a little hike in the interest rate. Like we want to incentivize the borrower to repay, but it's not overly aggressive. We don't want to put the borrower in a vulnerable position, but we do
Mhm.
want to incentivize the repayment of the loan.
Yeah.
Yeah, no, I agree. I get a lot of questions from investors. Well, if the extension is 3 additional years of extension, then they're going to do it, right? This is cheaper than the market rate. And I say, yeah, there's a little bit of protections depending on the year of extension. It generally is kind of like a ladder. So it escalates on individual years, whatever the amount of percentage bump is to incentivize, like Trevor said, the repayment of the loan.
And I think what's interesting as well is to see what kind of track record or history the lender and borrower have with one another. If they've been done this before, these won't be kind of exploratory missions in the future when they're trying to figure this all out. You talked about it a little bit before, where historians in a way, and if the NCE and the project have experience doing this together, there should be, I would think, a smoother process for everyone in the future.
Yeah, I mean,
Yeah, track record is tremendous help. I mean, it's no guarantee. I mean, don't get me wrong. There's no
Yeah.
guarantees in life, but a track record is a beautiful thing to look back on and give you added confidence.
I'm with you. Not only between the NC and the JCE, but also that JCE and the bank that they're working with, right?
Oh yeah,
Their
that's a
goal
good
is to
point. You do want to have
refinance.
a cooperative bank, don't you? One
Yeah,
that one that is
Yeah.
comfortable with EB-5, not trying to give everyone else in the deal a hard time.
100%. I'm backing that. I know Trevor has a long relationship with a lot of banks, as do a lot of the projects we work with, and that's important if their focus is to refinance.
Hmm.
So that kind of
Mhm.
goes into what that banking relationship is in the project of the location of the bank. Do they have experience not only with that developer, but in that area, right? We see a lot of banks that are regional that a Florida bank is very rarely going to loan to California. They just don't know each other's laws. And I think a local bank and a relationship there is really important.
Yeah, excellent point. And I do see those banking relationships again and again in different projects. And we see it also on the EB-5, the NCE escrow side as well. People who understand EB-5 are the ones that you want to get involved with when it comes to investing your money and triggering the release points for the immigration purposes as well. So let's get into now more about the project structuring, protections, guarantees, which is always a buzzword in the EB-5 space. So we've been talking about when we're talking about deployment and repayment. Just for some of those of you who are a little bit newer to EB-5, we're talking about funding that occurs between two different entities. The EB-5 investment vehicle that foreign investors are investing into, and then the project developer, their entity that they're using to receive the funds from the EB-5 investment vehicle to use those funds and develop the project. So over, the last 10 to 15 years, we've seen two primary investment structures exist in the EB-5 space, the loan model and the equity model. I would say typically the loan model has been a little bit more popular, but I have seen, a rise in interest in preferred equity deals where the EB-5 investment vehicles making a preferred equity investment into the project side. Um, Trevor, what are your thoughts on those two structures? Are you comfortable with both when seeking to put together a deal, or do you have a clear preference?
I don't like equity. I'll just say it. It's an unnecessary risk. Um, having said that, there's been some great equity projects and investors have done very well.
Hmm.
But I think you got to keep your eye on the price. You want to get your investment back and you want that green card. And the loan structure is simply the safest way to do that, assuming that you're in a secured position. There's a reason that the borrower doesn't want the loan, that they want to give you the equity. You know, they want to they want the lower cost of capital. If the project doesn't work out, which it very well may, you know, they're not on the hook. You're an equity investor. It's your loss. And so I wouldn't personally never structure an equity investment. I just think there's too much risk in that proposal that's unnecessary given all of the quality of alternatives.
Yeah, I understood. I mean, I think that is why we've seen some preference on that model over the years. Some of it is also controlled by demographics. Different areas of the world have
Yeah.
typically liked certain structures over the others. Andrew, I know you work with investors from everywhere. What have you seen? Can you build on that statement a little more in terms of are you able to generalize certain areas of the world preferring certain structures, or do you think it's really mixed now and a little less predictable than it used to be?
I think I think it's general still like a loan structure. That's the primary focus. I mean, people are doing this investment to get their return of capital and get their residency. I mean, that's what I've been seeing. I've been seeing protection. Protection is the number one focus. We continuously harp on that. We want a return of capital, not a return on capital. That's kind of a good way to say it.
Yeah. Yeah. I mean, when I talk with clients about their immigration process, number one priority, get the green card. Number two, return of capital. Number three, return on capital.
Yeah.
Those typically are the mindset that people have going into this, and maybe that loan model provides a little more assurance or predictability when it comes to the second priority that we're mentioning. Just to mention this to everybody out there, we will open this up to questions towards the end of the presentation. Don't worry, we'll be here for you and happy to field whatever questions come up. I should say that loans are great in terms of having timelines. How do protections get worked into loans, though? Projects don't always go as planned. Or even if it does go really well, I mean, what are you looking for to make sure that your clients are comfortable with it, Andrew?
Yeah, we'd like to be this first in this waterfall, or the first person getting repaid in the structure, right? There are sometimes you go into developments where there are hidden management fees, and that's kind of drawing down on the overall profitability of the asset. So ideally, we are protecting ourselves from an exorbitant management fee. We are first in this position to get paid out. We have a loan to whatever the cost of the structure is, or a loan to the stabilized value assumption at the end of the deal. There's percentage points that we try to get to that we know in the worst case scenario, like you said, we are in a senior position if the deal, in whatever deal it is. And if we had to go sell this asset, one, is the asset value today more than the amount of loan we're putting up as a fund, as a group of investors? Two, is there going to be a market for that asset? Are you doing a loan on an asset that has a value in 2022 when everything was peaking and everyone was going to be isolated and work from their secondary homes?
Yeah.
Or are you going to a major market that maybe you see today individuals getting forced to go back to work and they're now no longer wanting to be in an individual home in a rural area, right? So I think there's a focus of, is that asset that you do have a first position on, is that going to be marketable? Are there a lot of people that it can come in and take it over and finish it? Or is it too niche? So just because you have a first position doesn't always mean that it's a valued first position. You need to make sure that there's a first position on a valued asset.
Thanks, Andrew. That was very helpful. Trevor, you have anything to add to that?
Yeah, I mean, real simply, if you look at a business plan, you look at their cash flows, what happens if you take 10, maybe 20% off of the projected revenues, projected sales? Is there still, adequate value in the project? Can they still repay their obligations, including the EB-5 investors, the bank debt, whatever may be on the books? Right? Because like Andrew said, the market may change. The project may not be worth what it is today in 2 years from now. So we need to stress the numbers a little bit and be comfortable with the downside scenario.
Yeah, really good insight and pointers really when it comes to, what goes into evaluating what's the right project for you. Um, there are also guarantees that are worked into EB-5 projects, and guarantees are something that, as an immigration attorney, we have to be very careful about. We know it has to be an at-risk investment, any kind of redemption right by the investor, a guarantee, that they get a certain amount of money on a date certain is going to trip up the immigration compliance aspect of the entire process. But there are guarantees that are offered in the EB-5 world that are compliant with the EB-5 program. Three of those guarantees that I talk about, I've written about the completion guarantee, project completion guarantee, I should say, the EB-5 loan repayment guarantee, and then the I-526 petition denial refund guarantee. So just briefly on the project completion guarantee, I think of that as a belt and suspenders to make sure that the developer is going to create the jobs for the investors. At least on paper, that's the hypothetical value of the project completion guarantee. Andrew, I know you have some thoughts on this. What do you think of a project completion guarantee?
Yeah, I mean, when we go into this is just general terminology. When we start talking about EB-5, your initial verbiage of what you're reading is guarantee, and you're like, okay, if someone's giving me a project guarantee or EB-5 loan repayment guarantee or any of these guarantees, to what extent are they backed? Right? They need to be backed by some kind of, if someone gives you a valuation, you won't just take it for what it's worth on its word. You need to go deeper into the actual guarantee and make sure that it's backed by an individual or a fund or an investment vehicle that can actually complete this. So I think there's a lot of research that needs to be done behind the initial paper to support the guarantee. You can't just take it for what it is on its worth, but it's very important. If you
Yeah.
have the ability to alleviate job creation and you have a true individual backing you, then that adds a ton of value because we're in this for the residency first, right? That's general concept. Not everybody, but general. We want permanent residency. And if you can guarantee job creation and that the project will be created, whether it's at a profit, at a break even, at a loss, but if jobs are created, at least I accomplished my number one goal. So I think if that's supported financially behind its initial word of guarantee, then I think I'm pretty much behind it.
And Trevor, do you get into completion guarantees? Is that something you think needs to be part of an EB-5 deal?
Yeah, so I have a couple thoughts on this. So it definitely doesn't have to be part of the deal. It's great when the developer is willing to provide that. It speaks to their belief in the project and the fact that they'll be successful. But as Andrew was saying, a guarantee is only as good as the guarantor, right? If I personally guarantee a project completion, that's basically worthless. But if a very, high value entity or individual guarantees the completion, that means something more. Now, having said that, in practice, a completion guarantee is a hard thing to enforce, right? It looks really good on paper. You like to hear that the developer has it in place, but when the rubber hits the road, how is this going to, come into effect? How are we going to actually force the completion? How are we going to force the guarantor to put up the money to get the project done, right? There's a lot of people involved in a development project or whatever the project may be. It's not just about money always. And how do you get them to act on that guarantee? So I'd like to see it. It's a nice guarantee. But in practice, I personally don't put a lot of value on it. I just think it's really hard to enforce in the real world.
Yes, and so does the same analysis apply to an EB-5 loan repayment guarantee?
I'd say
When what's
yes.
yeah,
I'd say yes. Yeah, you still have to get someone to act on that. Now, on a loan, that's a financial transaction.
right.
Whereas, completion guarantee, we're talking about a business activity. We're talking about actually building a project. There's a lot more parts involved there. In a financial transaction, it's a little more straightforward. It's like, okay, we're going to put up the money, and that's the end of it. So it's simpler. I think it's easier to enforce in practice, but it still can be difficult to enforce, and it's still only as good as the guarantor behind it.
Sure.
And I think that plays for the 526 denial guarantee.
Yeah,
I
yeah,
mean,
Yeah,
if there's not like a fund there sitting with funds in escrow, then the general terminology of offering documents make you exhaust every possible route to get an approval, which could take years.
yeah.
And then if you get to that point, then only at that point, if you go through the full process of denial, do you get to meet the requirement of depending on the documentation.
yeah,
But a lot of projects do have a set aside fund for issues at 526. So I think you just have to look deeper into it.
yeah. Just the emphasis of reviewing those offering documents to understand what will trigger the refund of the capital if the I-5260 petition is denied. And to your point, what that timing will look like, what remedies need to be exhausted before the timing or the timer of the funding to be repaid will actually start. And each deal is different. Each project has something that they want to make sure is happened before they're going to be on the hook for refunding the investment. Not
Mhm.
to say that it's all smoke and mirrors. I-526 denials could happen uh, 2 or 3 years down the road. You could exhaust remedies after another year or so. Funding could be available at that time and be repaid. You could be the first person repaid out of the deal because you just don't need to complete anything else at that point. So it's very possible for that I-526 refund guarantee to be denial refund guarantee to be followed through to a T, but you just have to understand what the language says about all that in the offering documents.
Yeah,
Yeah,
just
Christian, I think that 526 denial guarantee is the most valuable of these three, like by far. And I've seen a lot of really good ones in practice, but they are not the same. As you guys have mentioned, a lot of them, have a lot of conditions. You got to exhaust all your options. You got to do this. You got to do that. We need to replace you with a different investor, and then we'll refund you. And then there's the guarantees that are just very black and white. You get a denial, we're sending your money back. And so they're
Yeah.
they're not all the same. There's some that work really good, some not so much. But of all the guarantees, I think the 526 denial guarantee, in my experience, has been the most valuable to investors.
Well, good. I think that's a solid statement to move on to one more thing we certainly need to touch on, which is the I-956F. Um, the I-956F application is one that each project needs to file uh, prior to EB-5 investors filing their own petitions in connection with that project. I-956F applications don't need to be approved in order for investors to start investing and filing. So you start seeing these scenarios where there are almost cycles or waves of having a number of I-956F approved projects in the market, and then all of a sudden very few. But EB-5 investors, the interest remains constant through the year. So what are they to do? Are they to wait for I-956F applications to be approved before moving forward? Or can they get into a project while that I-956F is pending? I can speak to a little bit about what constitutes the right timing of filing an I-956F application, which we should hope, which should be helpful in terms of making sure that that's a strong application from an immigration perspective. Um, but but what do you think about that? Are you all okay? Trevor, will you take investors Would you take investors if the F is still pending? Andrew, would you allow for that for a client of yours? Talk a little bit about that.
Yeah. I mean, we're not afraid to take an investor without the approval. Having said that, we have really strong denial guarantees. So if we need to refund, the money, we're not overly concerned. But if the regional center and the developer has a track record of, consistent project approvals, consistency within the EB-5 program, parameters, we can be confident that they're going to get the approval. So we don't necessarily need to wait or want to wait for the F approval before accepting investors.
Yeah, and we'll make this quick so we can kind of get questions in, but if you have like a viable team that created the documentation and they're managing the NCE between the NCE fund manager, the regional center, the economist, business plan writer, securities counsel, and immigration counsel, if that's like a well-versed team, I think you shouldn't really have an issue in getting these projects approved. But you could get secondary opinions from your personal immigration attorney on the viability of the 956 approval based on immigration aspects. And you could go out and independently hire, should the company allow you, an economist or business plan writer to give you their opinion. And that could alleviate a lot of the issues that may pop up with the 956 approval aspect. All
Yeah,
that being said, if the project is very marketable and it's out there raising capital, you better believe it that a lot of other people are waiting for that box to get checked at the 956F approval. And if you wait to the last moment and it's approved and you're not ready for another month because of source of funds, you may miss the boat. So I think take a look at those deals, make your own decision, reduce risk from the 956F, but don't be afraid to jump into a non-approved project.
Yeah, I agree. One of the things that clients speak with me about is if they have a connection with a group raising capital, with that EB-5 project, with that regional center, they want to stick with that group. This is going to be a process together. And so we start to look at that pending I-956F. Okay, well, what's the status of the project? Is it already underway? Is job creation occurring? Do they have financing lined up to complete the project? Ultimately, will USCIS feel that this project is shovel ready and everything is matter of how compliant in terms of the business plan, economic impact study, and are the offering documents compliant with the EB-5 program? From an immigration perspective, that's what's going to get the I-956F approved. So I know that projects are thinking through what's the right timing for filing that I-956F, not just from when should we start raising capital, but when will USCIS be comfortable with approving the application for the project? So a lot of that timing does go into when to file the I-956F application. So I know we're going to have some questions. I would real quick like to add a little bit more color on why does a project get into raising EB-5 capital? Why does a group think that this is worth their while? I mean, there's a lot of time and effort that goes into selecting a project, as we've talked about, using the EB-5 capital in the right way, protecting investors, thinking through repayment. Trevor, tell us a little bit about HomeFed and everything you've been involved with when it comes to getting involved with EB-5. We've got a few minutes to talk about that, and then I'll get into some of these questions.
Yeah. So I mean, most people get into EB-5 because they want to make money, right? EB-5 is a great program. It offers great financing at a relatively low cost. So there's a lot of great benefits to participating in the EB-5 program. Some projects, some developers literally can't get their project off the ground without EB-5. And that's a beautiful thing about EB-5 and this program and the way it creates jobs and it facilitates these projects that may not otherwise happen. Probably the majority of projects, including HomeFed, don't really need EB-5 financing. They can find other alternative financing, but EB-5 might lower their cost of capital slightly. Or in the case of HomeFed, EB-5 funding is just not necessary at all, right? The project's being built. HomeFed has other resources, other equity, other financing, lots of cash in the bank, and EB-5 just boosts our bottom line, right? If we can bring in a low-cost source of capital into our projects, that frees up our cash to do things other places. So EB-5 has been a great resource for HomeFed. Not something that we need. It's been great for me. It's been my job for the last 10 years, so I'm grateful for it. But it's really just an assist to HomeFed's core business, which is real estate development. It's just helping the company become more profitable. So as an EB-5 investor looking in, you're thinking, okay, that's a great opportunity to invest with a company that doesn't actually need my money. So I know that they're not strapped for cash. I know that they've got a track record, and I'm just able to benefit, from their great projects that put me in a very secure position. So I can get my green card, my money's safe. The developer makes a little more money. I'm happy for them. But as long as I get my money back, as long as I'm getting my green card, it's a win-win for everyone involved. So for HomeFed, EB-5's, been a great supplement to our business, and that's really all it is. It's making us more profitable, and that's just the truth of the matter. And that's the same for a number of different EB-5 operations out there. So we
Yeah.
love the government program, and we love to take advantage of it, and we love to help our investors in the process.
Yes, I think it's certainly not a one way to do it in EB-5. There's all kinds of relationships, affiliated, not affiliated projects, raising capital. So there's really good color on what you all have been up to over the last decade and how you've been assisting investors through their immigration process. So let's open up to Q&A, and I think that last discussion will really be a good segue to our first question. One of the questions that I see here is, what are the pros and cons of the developer also being what they ask is the regional center? What structure is best? So let's just first point out that I think we're probably talking about whether the same group is both the new commercial enterprise and the project. Whether the group is also the regional center is I think, a little less of something to think about. I mean, the regional center is oftentimes the compliance vehicle, and that alone, it's going to report to USCIS. If the same group raising the capital is also the regional center, I think that's probably a good thing because they know exactly what's going on with the project. Everything's going to be accurately and timely submitted to USCIS. There's not a lot to be lost in translation between those two groups. Now, when it comes to raising capital and deploying it to your project, Trevor, I'm sure you've answered this kind of question before. You want to help respond to that one?
Yeah, it's a great question, and it comes up frequently. HomeFed, of course, we're affiliated with our regional center, so we get this question a lot. And as you said, I think the real benefit is the autonomy and the flexibility. So, for example, our 526 denial guarantee, we're not having to go try and harass the borrower to give us some money back. Hey, we need to repay this investor. We had a withdrawal, we had a denial. For HomeFed, you're talking to the borrower and the lender. It's one entity. In fact, you're talking to me, really. If you want information on HomeFed's project or the regional center or the loan, you're talking to me. So it's a one-stop proposition. Everything's very seamless. We don't have that information gap. We're not trying to get details from the borrower and construction updates and project updates. Everything is at our fingertips. So we control the process. It's very seamless. It's worked perfectly for the last 10 years, and I don't see any reason why it can't keep going that way. Now, some will say that it's a benefit to have a third-party regional center because they're a fiduciary of the investor, which is true, right? If the loan doesn't repay, if the borrower's in default, that regional center is highly motivated to make sure that the borrower, pays on the loan, that they're paying their interest, which in turn benefits the investor. And so there's truth to that. There's benefits to looking at it both ways. But for HomeFed, it's been a fantastic program, and I can refer you to hundreds of investors that would agree.
Thanks, Trevor. So
Yeah, Christian, I just want to mention, the program has ebbs and flows. It is come and gone through legislation.
Yeah.
And there are some regional center operators or fund managers that cease to exist during gaps of the program. When you have an actual entity that plans to be around, whether or not EB-5 is around, I think that's also valuable.
Yeah.
Yeah, good point.
What?
So this next question is going to be a 2-for-1 to you, Andrew. I'm going to build in 2 questions for one. What are some, I know we've talked about this through the presentation, but what are some red flags, and how does one mitigate risk in EB-5? I know that's very general, but touch on a few that we've talked about.
Yeah, no
Red
bank
flags.
financing. If you're not doing bank financing, I understand. But if you are planning on it and you just say you're in discussions and you don't have documentation to support that, red flag. If a regional center is telling you something on a presentation, but they can't point it out to you on the offering documents, or they refuse to email you anything, red flag. If the person doesn't have any repayment history whatsoever. And that could be because they're newer to the market. That doesn't mean it's a bad thing. But a repayments history does help. Whether it's in this deal with EB-5 or whether it's actually in another deal. You don't want to be a guinea pig for new developers coming to the market trying their first deal, not putting their own dollars into it. They're not personally vested. So I think it's important that you have developer equity into the deal, there's skin in the game, there's protectors. This is not their first deal, right? In this type of asset, whatever it could be. So I think with just those alone, and if the people backing it aren't educated or experienced in EB-5, I think that's also a red flag. I always kind of use the analogy of individuals that come to me uh, talking to an immigration attorney that this is their first time doing EB-5. The analogy is for surgeons. If you're focused on doing orthopedics and you need them to do a heart surgery, their specialty is orthopedics. You don't trust them to do heart surgery. And I think this is super important to you, not only financially, but your future of you and your kids. It's important to use an immigration attorney and a team that's experienced in specifically EB-5 topics.
Couldn't agree more. You want to have anyone involved knowing what they do, all
Yeah.
about EB-5. So, um, yeah, I thought that was great. So, let me get to another question here. I'm gonna answer this one. I think this one is very specific. They're kind of trying to understand how to walk that line of immigration support versus financial advisor. It's a really interesting question because they're focused on they feel that it's a little more clear on the regional center side, but when someone goes into a direct investment, how does someone like myself as an immigration attorney not become a financial advisor, give them investment advice? And I think it's actually quite straightforward. I just hammer again and again how any project will work for EB-5 immigration purposes. What structures will work or won't work. How the funds being used on that business will work or will not work for immigration purposes. My engagement agreement spells out very clearly that I'm not giving investment advice. I'm not a financial advisor. They're hiring me for their immigration process. And part of that immigration process is to make sure what the funds are being invested into are compliant with the immigration, EB-5 immigration program. So I think it stays very clear when I'm representing a client that that's really what they're looking from me when it comes to making a direct or regional center investment and filing. That is time. We've been here for about an hour now, and I think we've had a great discussion. Andrew, Trevor, thank you so much for all the insight you shared. I know I learned a thing or two listening to both of you, and I hope all of you out there listening as well got a lot out of this. Again, I think it's a very interesting and important time in EB-5, a lot of predictability moving forward for the next year, and I encourage you to take advantage of working with experts in the industry as we've talked about that again and again today. So thank you very much. Thank you, Andrew and Trevor.
Thanks, guys.
Thanks,
Appreciate it.
Christian. Thanks, everyone.